Hello, everyone, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way to exit your highly appreciated assets tax deferred so you can create, preserve, and grow your wealth. I'm your co-host, Chris New York, filling in for Brett Swarts. And each episode, I'm joined by some of the best wealth, business, real estate, and leadership individuals in the world to share ideas, deal stories, and inspiration. So together, we can make complex tax deferral strategies simple and passive income plans achievable. We're also streaming on Expert CRE Secrets, Capital Gains Tax Solutions YouTube channel, the Kingdom Luxury Realty YouTube channel, and the Kingdom Luxury Realty Facebook channel. And I'm so excited about our next guest. The legend himself has been in real estate since the early 80s, and over the career have acquired close to 5.5 billion worth of real estate. He's got a wealth of knowledge that he's about to dump on us, and so buckle up, guys, because it's gonna be awesome. So, Mark Hamilton, how you doing?
Good, Pierce. Thank you for having me on your program.
Yeah, absolutely. So that's quite a feat that I was reading in your company's LinkedIn bio over there. So how did you get there?
Well, it didn't happen all at one time. As you mentioned, you gave people a clue that I've been around for a while. And in fact, I got into real estate truly by accident. We can go into that if you want, in 1981. But the long and the short of it is when we started buying assets, it was a very small organization. We were doing very small things. The first iteration was my wife and I. We bought a duplex that was kind of a horror show, but we rolled up our sleeves and turned it around and made it into something better. And then my boss at the time noticed what we were doing and was curious, and he kind of decided he wanted to play angel investor. So he put up the money, and we did I found the assets and handled the transactions. And my wife quit her job running a factory for her family, and got her general contractor's license and started running the jobs. Shortly after that, we became partners with another married couple who were doing the same thing. They were friends of hers from back east. And we were really focused on, what you might call rough and tumble real estate in transitional neighborhoods in San Francisco. And it worked out. We were good at it. We liked it. We all quit. We all ended up ultimately quitting our jobs to form a little company, and that was in 1988. And there were 4 partners and 1 employee. The employee was my brother, but he knew his way around a piece of property and knew how to manage subs and get work done. And then it just grew. It wasn't always, it wasn't always painless, and there wasn't always growth. There were periods of idleness and periods of pain. And by the early 90s, our partners split up, and that was the beginning of the dissolution of that enterprise. And it went into another configuration first, but my wife ended up taking the management operation and building her own management company, and I took the investment into the business and continued doing this. And in the 90s, I operated interchangeably with a couple of other partners. We were still using friends and family money and our own sweat equity and putting our own skin in the game. And then so by the end of the 90s, I probably had a portfolio of around 400 units, maybe not quite that. All of it in the Bay Area, San Francisco and Oakland. All of it value add property. And in 2001, I met Tony Zantz, and Tony Zantz had an institutional pedigree, whereas mine was much more local and very low to the ground. Tony was on the institutional track. He got an MBA from Wisconsin and made a number of stops at distinguished institutions. And by 2000, he was just kind of tired of the whole institutional thing and felt that he could make a better life for himself and have a more enjoyable career if he got on the entrepreneurial track. And I mean, I'll tell you, when he proposed it, I hadn't known him until 2001. I got referred to him by a mutual friend. And when he proposed it, I told him I thought he was making a huge mistake. It's like, why would you give up that job to do this? It makes no sense. You have a wife, you own a house, you have a child, you have bills. You're gonna give that up and do this? And he basically said, I'm tired of the corporate track and I'm tired of making everybody else's money for him. I said, well, I got no downside, because if it doesn't work out, I'm just going to keep doing what I'm doing. You're taking the risk, but I got no problem. Let's do it. And so we joined forces. It was he and I, and we had one employee. The first transaction we did in late 2001, right after 9/11, which also gave us some pause, was a 16-unit building in Oakland. But that was kind of the range that I was working at the time, 10 to 40 units, maybe sometimes something bigger. And it was a good fit. And he, I kind of had the rough and tumble part of the business, whether it was dealing with contractors or permits, projects, dealing with landlord-tenant matters, most of the stuff that's not classic asset management, most of the kind of grittier stuff. And I stayed close to that. That was part of the business that I really liked and still do. And he brought in institutional practices and a truly institutional approach to asset management. And so we just grew slowly. And that was 2001, and we grew slowly through the 2000s, and then had a reckoning in 2008, 2009, 2010. Things slowed down a lot. Property performance was a little beat up, but we got through. And for the most part, we were able to continue making distributions to investors. We did downsize. We went from 26 employees to 17. And then since then, we've been growing again. And, we're now up to about 60 employees. Our portfolio is about 24,000 units in, I want to say 27 metro markets in 16 states. And we also have a smaller sister company that does mostly suburban office that's called Graham Street Realty. And we've probably purchased 500 or 600 million of office properties in Graham Street since 2008. And then we also have the operating companies. Paramount operates the commercial and does third party. And Mission Rock, which is led by some industry stars, operates the multifamily, and they have third party also. But it's been a wild ride. It's been unexpected. It's been good. We believe in what we do. We practice what we preach. We put our own skin in the game. All of the equity is friends and family or referrals from friends and family. We've never used a broker dealer. We don't advertise. We don't pay commissions. And it's largely, I really think it's largely a function of really liking the work and really liking and loving each other. We gotta go to work every day and do this stuff and hang out with people and really believe in it and practice what we preach. And, there's a lot of power there. And we continue to put into the organization and put into the investments every year. And, so now we're 21 years in at Hamilton Sands. And I think we've definitely passed proof of concept, maybe a little more, but it's been good.
Maybe a little bit proof of concept passing over there. So, all right. So I have like a bunch of questions for you.
I got all day.
Yeah. So your partner coming in, and you said he brought in the institutional strategies.
Practices, yeah.
Practices. Dive into that a little bit.
So I would say really three things. He knew finance very, very well. He ran the West Coast lending office of GE Capital at one point. He ran a lot of equity and debt at Northwestern Mutual. And his MBA from Wisconsin was in real estate and finance. So he knew finance a lot more than I did. My appreciation of the subtlety of finance was, call a loan broker, get the best rate, right? And he certainly had a more refined view of debt, and all the different debt products that you can get, whether it's fixed or variable, you're using swaps, how much leverage do you want? Are you going to consider using mezzanine debt or not? Which we don't. We never have. Are you going to go IO for part of it, or how much amortization do you want? And he was an expert at that. The other thing I would say is that he brought more institutional practices in terms of asset management. My approach to asset management was always basically as follows. I mean, in the run up to my acquaintance with Tony, as I said, I had a portfolio of probably 300 to 400 units, older buildings primarily, and my work area was insurance and claims and litigation, capex, contractors, maintenance and repair, dealing with permit matters with the various cities where we were, dealing with the landlord-tenant matters, and it was really much more of a special projects or problem children emphasis. Yeah, that's kind of my part of the street. And Tony really brought in an emphasis on reports. And so before Tony came in, I met with my wife once a month, she and her partner managed the apartment portfolio. And I shared office space with them. So I just walked through the door and go over to her desk and do the rundown every week on what's going on with the properties. And I was always focused more on special projects and hotspots. I knew she was in charge of the accounting and was doing proper reports and dealing with all the accounts payable and receivable and all the rest of it. But when Tony came in, he brought a lot more expertise and emphasis on the reports, whether it's the P&L, the balance sheet, the rent rolls, adjustments to market rent and whatnot. And so he brought that expertise, but he also brought expertise in the form of knowing how to work with institutional partners. Historically, we've done probably 15 to 20% of our volume has been JVs with institutional partners. And Tony, I've learned a lot from him in the last 21 years. And I certainly can hold my own in conversations with institutions. 21 years ago, that wouldn't have been so. And so, it's just a really good fit. And, temperament was a fit. And, the things that are important, like culture and ethics, were a fit. And consequently, we've been able to draw a lot of really outstanding people into the firm. And last year, we promoted Kurt Howcooper, who joined us in 2003. We promoted him to CEO, and he's a partner. And then we promoted 6 senior staff into partnership positions. And so I would really just say that so much of it has been about loving the work and getting to run with great people, and being honest about it, right? Being serious about the work and not kidding ourselves about things. Apartments it's a daily grind. If you're on site at any of the apartments, it may be an hourly grind. There's always going to be activity. But if you show up for the work and you don't try to kid yourself about the work, you're probably going to be okay. Some of it is about problem solving, but it's worked out.
Yeah, no, absolutely. So the institutional practices that came in were just creative and a in-depth knowledge of how to finance a lot of these deals. And then on top of that, having the reports and everything that were squared away so that when you went to go get those finances, things were super simple. They were just streamlined and real easy. So he knew how to basically get you guys funded for all of these deals.
Yeah. Certainly I've been doing it at that point in time. I'd been doing it for more than 15 years. But it's pretty basic. I had lenders that I worked with, and when I needed a loan, I'd pick up the phone and get started. He knew much more about creating a marketplace for loans than I did, and really pretty much always did that, so that we're getting optimum pricing every time we go out. And otherwise, it's just institutional practices about, accounting and reports and balance sheets and all the rest of it. And he had a real, and to this day has a real passion for that kind of stuff.
So how do you create that marketplace?
Well, in very simple terms, one way we're doing it now, and it happens most often on the commercial side right now. I can speak to how we finance on the apartment side as well. But when we're doing a commercial transaction, which is going to be it's going to be office or it's going to be office flex, um, the our partner who runs that business is a fellow named Dave Messing, who's a banker by pedigree. He will he will hire a loan broker and he'll make sure that the loan broker puts it out to a number of different lenders. If the loan broker is going to put it out to one lender or two or three, the loan broker's not doing their job. But the loan broker will probably put it out originally to, initially to maybe 10 to 12 lenders. And then, there'll be some who say no thanks, and there'll be some who really want to do it. And then we'll winnow that down to a pack of probably 5 or 6 lenders who give us term sheets. And so by going out to the marketplace for loans, it becomes competitive, and you have an opportunity to get the best terms. And that's how I would say it, again, in simple terms. You create a marketplace for your financing. On the other hand, for apartments are a little different. We're very loyal to the people who bring us properties. And so if we're going to refinance an asset, it is almost a certainty that we're going to refinance or put a supplemental on with the team who put the debt on in the first place. If it's a new acquisition, the truth of the matter is that in the marketplace today, most of your big brokerage firms, whether it's CBRE or Cushman Wakefield or Procadia, Walker Dunlap, Newmark, whomever it might be, the big firms that probably control 80 to 90% of the market above $10 million. The brokerage team will also have a lending unit on a lender or a lending team in their organization. And so the brokers these days really, it's almost a default that you're going to work with the lender, with their loan desk, right? They're not only going to help you buy the asset, but they're gonna basically insist that they put the financing on it, and that's fine. We have really strong relationships with 6 or 8 lenders, and we're loyal to them, and we respect the process that the loan is going to go through their lending desk. But even on their lending desk, they're going to give you options. They're going to give you fixed. They're going to give you variable. If you go variable, you could talk about getting a cap or getting swaps. You talk about interest only. You talk about amortization. You talk about different term. And so it's the job of that loan desk to give you an array of options so that we can then pick the option that best suits the strategy. And the strategy is usually intermediate leverage, 60 to 70%, cash flow intensive, and interest rate stable. So that's how we do it.
Yeah, and that's awesome that creating that marketplace, so you're getting the best terms on your loans that you can. And so with all of that, right, you guys acquired a bunch of properties, right, and having that high level expertise on how to go about doing it, like a big institutional company would. Are you guys still like acquiring properties that way, or has the whole COVID landscape changed how you guys acquire properties at all, or what's going on with that?
No, it hasn't changed. Last year, we typically buy over if you take out 2021, and let's just say from 2011 to 2020, 2011 might have been a little low in terms of volume, but generally speaking, we're going to buy between 4 and 800 million in apartment properties in a given year. Last year was off the charts. We tied into a bankruptcy portfolio in the Bay Area, and the portfolio purchase price by itself was about 450 million. And then on top of that, we had a big year in terms of what I would call routine deal flow, and that resulted in about another 700 million. So last year we bought, actually for apartments, I think it resulted in about 800 million. So we paid 800 million for kind of our rank and file apartment inventory last year. We paid another 300 million in apartments for this bankruptcy portfolio, and then we paid about 150 million for the office assets in the same portfolio. So between the two, we had about $1.3 billion of transaction volume last year, and that was unusual. And again, because it was bankruptcy, the ropes, the gears, the levers, the people involved, it was all very different. It was a one-off experience. There were people we knew. A broker was not retained. The bankruptcy court was obviously in charge and working through the trustees and the people on the creditors committees. And our partner, Kurt Howcooper, who's just relentless in terms of transactions, just got on it, stayed on it for about 9 months. And that was how long it took to close it. But we sourced the capital a different way for that. We put our own money in it. We also made sure that there was going to be room for friends and family, but we also did a JV with a large East Coast institution, and then we used Wells Fargo for the debt. Historically we've had a really good relationship with Wells Fargo for a long time, and this was more of a custom because of the state of the bankruptcy and the state that the assets were in at the time. It was more of a custom approach to putting the financing on it. Whereas, routinely we're going to get Fannie Mae or Freddie Mac debt, and it's going to be fixed rate debt, and it kind of snaps together. But in this, there was a lot of custom framing that had to be done by everybody working hard on it.
Wow. So 2021, good year. Now in 2022, are you liquidating and getting ready to get on the sidelines and wait for a dip, or what's your strategy moving forward?
That's a really great question, Pierce. And what I would say is we're never on the sidelines. We've never been on the sidelines. We think that there's always good work that you can do. It's gonna differ from year to year based on market pressures, based on the amount of capital that's chasing properties, which push prices up and returns down. It's going to be based on operating conditions. It's still a very strong rental market, and I expect that will remain the case even if we go into a recession. But I'm sorry, can you repeat the question? I totally lost
Are you guys liquidating?
No, we're not
liquidating assets at all.
In the last 15 years, 16 years, we've been out of contract as a buyer once for a week. And other than that, every other week in the history of the organization, we've had something in contract that we want to buy. And we could do that because we're in more than one market, right? We left the Bay Area for quite a long time for apartments because we just couldn't get returns. We didn't get the returns that we wanted. So we started going elsewhere. And every time anywhere else has got priced out, we looked to the next market. And so, like I mentioned earlier, that we're probably in 27 metro markets. Originally, we were in one, and then it was two, and then it was three, and we just kept looking. Right? We're really kind of obsessed with finding returns. But right now, we can look at 27 markets, and we're probably also looking at some markets that we're not currently invested in. So we're always looking for new markets to look for returns, and a lot of markets are closed to us right now because the prices are just too high, and we won't be able to make our numbers. The flip side is a great time to be a seller, right? In our business, it's a little bit of congratulations, I'm sorry, because if you're a seller and you're a 1031 practitioner, which we are, it means you're going to sell something. You're probably going to realize some nice gains, but then you're going to have to go back out and find something. And that's not the worst thing in the world. Leverage is down right now. Historically, we like to be 60 to 70%. Right now, it's probably 50 to 60%. Cap rates are very low, which means cash flow is compressed. But if we make, if we have a nice result on something that we're selling, and I'll just tell you, it's a white hot market right now if you're a seller. And if we have something that's I would say a minor victory right now when we're selling it, we're still coming out uh, making at least 100% on top of the cash flow that we've
Wow.
distributed. Right now, that passes for kind of a ho-hum return. We have, we're seeing 3x, 4x, 5x, 6x. I'm not kidding you, and it's crazy. We didn't anticipate it. Whenever we have these events, I tell the investor to enjoy it and then to forget that it ever happened, because the returns, and you can't sustain returns like that. But if
Yeah.
if you make a 3x or a 4x, and maybe you were distributing 6% before, on $100,000, that's 6,000. But if you make 4x, even if you come out at 4%, you're still making 16,000. So in
Right.
absolute, the returns may fall, and they do, as a percentage, as a rate of return, but in absolute terms, they're still going up. And our investors, quite frankly, they don't even think about the rate of return. They just look at their bank statement. They want to see that they're making their cash flow,
Right.
and when it can, that it's going up. Um, it's a very user friendly experience for the investor. It's very turnkey. We do everything in house. Um, we send the distributions out from our world, so and we watch it very closely.
Yeah. No. And that's I want to speak to something that you just said. So you guys are 1031 practicers. What's been your biggest frustration with the 1031?
That's an interesting question. I'd say, really, we don't have any real complaints. I mean, there are certainly a lot of details that you have to follow very closely, to make sure that your exchange is gonna qualify, and that it would stand up to an audit if you got audited. So I mean, there's a fair amount of particulars that are involved, and also from time to time we'll do an exchange. Any one acquisition that we acquire through an exchange might include 2 or 3 or 4 of our own partnerships, and then 4 to 6 tenant and common investors who are clients of ours who have their own exchange that they want to complete. So we may have anywhere from, it's usually going to be 5 to 10. Sometimes we can get more, but it's usually going to be 5 to 10 investors on the title. And there's a fair amount of heavy lifting and brain surgery that's involved to get that done and get it snapped in place, and just close, right? And to close knowing that you've dotted all your I's and crossed your T's. I would say that for garden variety investors, maybe even for experienced, sophisticated investors, the aspect of the exchange, that has to be looked at very closely, aside from just getting, making sure it qualifies in terms of the date of designation and the date of the acquisition and debt replacement and equity replacement and all that. You have to be very mindful of other costs that are being paid that don't count as real estate replacement, right? If it's certain fees, might not count as real estate replacement. Reserve, funding a reserve at the property does not count as real estate replacement. CapEx, if you build a treasury to do CapEx at the property, that's not going to count as real estate replacement. And so you could tell yourself you've done the perfect exchange and still have capital gain exposed from it. And so one of the things that we do is we make sure that the costs, and uses of funds that don't necessarily count as real estate replacement, that we fund those with cash. We fund those with new cash, so that it doesn't create the capital gains headache for somebody who thinks they've done a perfect exchange.
Yeah. So okay, the expenses that aren't basically related to real estate, people aren't accounting for them, and then once they've done their exchange, it comes back and it's like, hey, now you're going to owe for this number that you guys didn't account for.
Sure. So let's just pretend that it's a $10 million asset, and you've got something that you're going to do a value add strategy on. You're going to do a lot of work. inside and outside. The apartments, common areas, roofs, fitness center, clubhouse, parking lots, landscaping, unit interiors, etc. And let's just also assume that you decide to fund a reserve for operation. And then you have some other costs, some other fees that might not count as real estate replacement, whether it's your legal fees for your attorneys, title and escrow, loan points, whatever else it is. And let's assume that all those costs come up to $2 million. That sounds like a lot, but let's not forget that you're kind of putting together $1 million to $1.5 million war chest for capex and then reserves and some other things, right? And so you've sold the property, and let's say your lender's going to give you 50% against total cost, right? So you're going to get a loan for $6 million and you're going to fund $6 million in equity. And let's say that fits perfectly with your exchange. That you've sold the property, you made $12 million net, you had a $6 million loan, you got $6 million in cash, and in it goes, right? You complete your exchange. Well, everyone's going to say, great, you did a terrific job, you completed your exchange, but you have $2 million of capital gain here because all this other stuff that you funded is not real estate. It's reserves, it's capex, it's fees, it's what have you. And so we every time get very far down in the weeds and look at the costs that we're going to have that we know will not qualify as real estate replacement, and we fund those with cash. And so if you're an exchange investor and you're in that scenario, you sold a $12 million deal and you bought this other thing, you just need to know, you need to have your eyes on the parts of the execution that aren't going to be helpful for your exchange, because in that scenario you would have some capital gains tax.
Yeah, and I think a lot of people do miss that, and then they get slapped with it, and they're like,
yeah, then they're surprised.
Yeah,
I mean, the exchange accommodator is going to do his or her best to make sure your papers are in order and to make sure that you've designated appropriately within the 45 days and that you've closed on time and that your money moved and that you got new financing and all that. But your exchange accommodator is not going to get down in the weeds on other cost areas in your acquisition. And for that matter, your CPA might not either, unless you have a really good real estate CPA. But you have to look at an exchange holistically and look at all of its parts. Not just not just the comparatively straightforward transaction parts.
Yeah, absolutely. And that's one of the reasons why we use a deferred sales trust. We love 1031s, right? When they make sense and when you can find the right thing. But what's unique about the deferred sales trust is that you can sell an asset. It doesn't have to be real estate. It can be any asset, business, stock, commercial real estate, primary home, and whatever, Bitcoin. And then you can go into any sort of asset you want. It's not following the same rules as a 1031. It doesn't follow the time constraint laws. It doesn't have the like kind restrictions. So you can sell an asset, put it into super conservative investments, and then wait until that real estate deal pops up, and then you can go and you can purchase that deal. It's kind of like your ability to different codes and all that, but for conceptual purposes, it's kind of like 1031ing into a self-directed IRA account that you can use to go out and invest in whatever you want. And what's great about it too is that it allows you to break up syndications too. So if you got 10 of your investors and only and 3 or 4 of them don't want to go, well, if you're not buying those guys out or doing something else, right, you're basically your 1031's kind of dead. Well, in this case, you can basically use each individual person can use their own deferred sales trust and not have to pay the capital gains tax, and the ones who want to can just take their money and they can go. So it gives you complete flexibility to control the timing, the asset, what asset you go into, the investment, when and where, and it gives cash flow and diversification. It's a phenomenal tool. It also moves assets outside the taxable estate. And so you're not, your heirs aren't subject to that 40% death tax when you are liquidating those assets. And so that's a whole nother conversation. But
Yeah.
you
You're
know,
gonna have a pretty big estate if you're paying any any inheritance tax.
yeah, you got to have over 20. It's like 22
Five,
million something.
25 million.
Yeah. So, it's definitely up there. But those people do.
Sure,
I
of
I
course.
imagine you'll be up there.
Well, maybe
Maybe.
if I don't give it all away first.
Yeah. So, but anyways, that's kind of cool. So I'm curious, have you ever used a deferred sales trust? Have you guys ever looked into it or heard about it?
No, and in fact, Pearson, thank you for asking the question. I know very, very little about deferred sales trusts. I gather that some people might describe it as a tool for affecting what we would otherwise call an installment sale. That you put the machinery together and then put your asset in, and it goes over to somebody else, right? But in a trust, and then you can elect to get payments out of the trust. And as you get payments out of the trust, you have that money exposed to capital gains taxes, but you can time manage it that way. And to me, especially given the use of the term installment sale, whether you would say that's accurate or not, I understand it is that the installment sale is used from time to time to discuss deferred sales trusts. But that's a little bit like carrying paper.
It is.
Carrying paper again is an
Yeah.
installment sale, and if I
Using the
wanted
same
to,
code.
yeah, if I didn't want the gain, or I didn't want it all at one time, or maybe I don't even want it in my lifetime. Um, I could carry paper. I could sell something, and I could carry the paper. Whether I get payments on that periodically while I'm still alive, or we put a fuse on it so that it's not likely to come due until I'm gone, and then that goes into my estate. I get that those are means of managing the exposure, time managing the exposure, and sizing it periodically so that you're content about the taxes that you're paying as you do. We're straight up 1031 practitioners, and we use really three approaches. As I mentioned earlier, we're big practitioners of the tenancy and common structure, which we've been using for a very long time. Routinely, even on that first transaction that Tony and I put together in 2001, we put together a partnership. We didn't have to raise a ton of money. I think we raised $300,000 or $400,000. But we put together a partnership, and we raised a chunk of money inside the partnership, and his father was in an exchange. So that was our first. That was probably our first tenancy in common execution, but it was our very first deal together. And so you had two entities on title. You had this partnership, and then you had Tony's dad, right? And so we were able to basically, that was a very elastic structure, and especially in the years prior to 2008, with CMBS loans, commercial mortgage-backed securities loans, conduit loans. You could put as many as 35 people on title, which was a lot, right? And we were able to take exchange capital from people who wanted to give us $100,000 or $150,000 or something like that. And we'd pool all of our capital that way. But in 2008, the CMBS markets seized up and basically went away for 3 years effectively. And we moved over lock, stock, and barrel to Fannie Mae and Freddie Mac. And they hadn't really become accustomed to the tenancy and common structure at that point in time. But initially, they let us put five entities on title, and then pretty much now it's 10. They will make exceptions from time to time if we have the need to put more people on title. It might be 12, it might be 15, but usually it's going to be around 10. And so the 1031, the garden variety 1031 and the tenant common structure has probably carried the burden for 75 to 80% of our transaction volume over the years. In the last few years, we've also started doing Delaware statutory trusts, which is a different strategy, but it is once again a like kind strategy. It's not an installment sale. It's not a deferral. It's a like kind exchange strategy. We like that too. And we don't raise money through broker dealers. So it's very efficient for the investor. And so then the third approach would be if we're working with a high net worth family, and they really don't want, they really want to complete something for their family, right? It's for them. They don't want other investors in, but they don't really want to be alone either. They want us there for expertise and handholding and doing the asset management. Then we'll do what we call a separate account, and and we'll take that on as an assignment and go out and find suitable replacement properties. And then generally speaking, they're going to put up the majority of the capital. We'll put in our own capital if they want us to. And that would be the third way. But these are all classic 1031 approaches and don't really use other strategies.
Yeah, and like I said, 1031s are great, right? When you find a deal, we've just found that sometimes, especially in markets that are appreciating, right? You're selling high, and then you're buying higher 180 days later. You're and you got to go back in, and we found that a lot of people get in trouble because they become desperate and motivated buyers. Not saying that's you guys at all, but this is what we found is that they become in a they put themselves in a poor position and to negotiate and to because they got this time constraint. They got 6 months to do it, and so we've seen them get slapped. One of the greatest stories that we had a gentleman who had a $20 million apartment building next to the Minnesota Vikings stadium. And he couldn't find an up leg for the 1031, and he ended up doing a deferred sales trust, sold the asset, deferred roughly $3 million in capital gains tax, and then put everything into super conservative bonds and mutual funds, 4.5%, and just kind of waited. And in 2012, the bank called him and they're like, "Hey, that property you sold back in 2006, that one to the 1031 buyer." And they're like, he's like, "Yeah, what about it?" And they're like, "Well, we're foreclosing on it. We want to know if you want to buy it back." He's like, "Well, how much is it?" And they're like, "It's about 40% off what you sold it."
Wow.
He's like, "Yeah, give me 3 days." And so he partners with his trust. He turns around and he bought the property back that he sold, and he got a brand new depreciation schedule on top of it.
Yeah, of course.
And so
that's a good problem to have.
Yeah. And the thing is that you get what you get with it. It is, you're spot on. It's a IRC code 453. It's a seller carryback at its fundamental core. But what's different about that between a traditional is that you get the benefit of the full capital up front without having to wait. And then you can take distributions when you want. And as long as you don't dip into principal, you're not paying capital gains tax. You'll pay ordinary income tax if you on the interest or whatever. But then it gives you the ability to go in, and you don't have to rely on someone else to, make sure your asset stays valuable. If you foreclose on somebody, right, who's to say that they managed it well? Probably not. And they could have trashed it or whatever. So if you default on them and you get your asset back, it could be totally devalued. That you got to go in and put a bunch of capex in or whatever the case may be.
Well, there's an interesting stat. I mentioned that we work with institutional joint venture partners, and we've worked with Cantor Fitzgerald quite a bit. And worked with them, helping them get into the apartment arena for the sake of completing Delaware statutory trust investments.
Yeah.
And they told us that 6 out of 7 people who go into an exchange don't complete their exchange. Wow. That's staggering.
Yeah, that's crazy.
And to me, how I decode that is somebody sold it because they didn't want to own it anymore, right? They were ready to be done. They were probably going to make some money. Okay, so let's do this. We'll open the exchange. We'll open escrow, we'll open the exchange account, etc. The money will go into the exchange account. They complete their down leg sale. The money goes into the exchange account, and they look and they look and they look, and they can't find something that they're comfortable with. They can't find something that's less aggravating than the thing that they sold. They can't find a sponsor to work with who makes them feel comfortable. And it's like, why am I going to do this, right? I guess my downside is paying the taxes. But do I want to have sleepless nights, right? Do I like the strategy of the sponsor? Am I going to be happy with this asset? And so when 6 out of 7 punt after starting an exchange process, that tells you that people have second thoughts, as they should, right? It's for anybody, it's going to be a material portion of their life savings. You want that to be safe and sound, right? And you don't want sleepless nights. If you're going to do an exchange, you should whatever you're going to do, you should do it in a way that you get to sleep every night, right? And if you're not doing that, you need to look at other things. And so it may be that the Deferred Sales Trust is a good alternative for people, because they're really ready to be out of the game. As you said, they sold high, right? They got their chips off the table when things were strong. They can stash their money into a structure and take it out periodically and pay the taxes periodically. If that helps somebody sleep at night, that's definitely what they should do.
Yeah, absolutely. And it's just a it's a staggering, thing that you said that 6 out of 7 don't complete their exchange, and it's just kind of like, I don't know. It seems like, almost after talking to so many people, that people understand the idea, but they don't understand the actual 1031 exchange and how to make it work for
Sure.
them. And so people get caught.
Well,
And
and then you got to put your money with a stranger, right? Even if you're going to complete your own exchange, your exchange accommodator is going to hold your funds for a while, and maybe they're
right,
not a stranger, right? Maybe, but your funds are going to be held by a third party, right? That probably gives some people the jitters. Um, and peace of mind. If somebody's contemplating an exchange, they're probably ready to be done.
right,
Certainly with their down leg. And the first thing you should get out of an exchange strategy is peace of mind. And if you don't get it, if you're not getting peace of mind, and you're going to be second guessing yourself constantly and staring at the ceiling at night, don't do it.
yeah, no, absolutely. And I think that's super sound advice. Um, I've almost kept you for over 45 minutes here, so I want to make
I'm
sure
game.
I'm respectful of your time. But so I wanted to ask you: Are you guys currently just like hammering a particular market right now?
More than one. The West Coast, things in the Western time zone are really hard to buy right now because they're so fully valued. I'm gathering that you might be in California.
I am.
Yeah. So prices are insanely high.
Yeah, we're nuts.
Returns are low. Leverage is low. So it's hard for us to acquire in the West right now, and that's certainly true of Arizona as well, and for that matter, Las Vegas. Las Vegas and Reno. Anything that's in the Western time zone is very, very fully priced, and I would include Utah there, although it's in the Mountain time zone. Oddly enough, we love Colorado, and we're still making transactions happen in Colorado. Colorado, the I-25 corridor of Colorado, from Colorado Springs through Denver up into Fort Collins, has been our number one market for the last 20 years. We've done more volume there than anywhere, and we've done a lot of volume in other markets, but Colorado's been number one, and we've had great results. And so, curiously, we can still, we're still working on Colorado. Texas, for the most part, we're selling right now. We have owned in New Mexico, but don't own anything in New Mexico right now. We're in the KC market. We're in the St. Louis market. But I would say where we're seeing the most opportunity is the Mid-Atlantic. I wish we could buy more in Georgia right now. Georgia is very fully priced. We've never owned in Florida, mostly because of yields.
Yeah.
But last year, the year before, this year, we're still getting good looks in North Carolina, Virginia, Tennessee, and Maryland. And I think probably 2/3 of our deal flow this year will be in one of those markets. And we do. That's what we do. We hammer it. We'll take in 3,000 to 4,000 submissions a year.
Wow.
We'll probably underwrite 10% of that or less, because it has to have a certain probability to it that it's going to work for us in order to want to underwrite it. And if we underwrite 250 deals in a year, we'll probably make 50 offers and maybe buy 15 to 20 properties. So you just have to hammer it constantly. And we have, we have a great transactions team. Our transactions team on the buy and sell side is 8 or 9 people, and it takes that to create any deal flow.
How about like what about in like the Midwest markets?
We'd love to be in Minnesota. Minnesota's the yields are low. We'd love to be in Wisconsin. Yields are low. Jury's mixed on Illinois. There are a lot of parts of the Chicago metro that we like, but it's not clear that they're really gaining population, and they may be shedding businesses. Um, a lot of businesses complain about how stagnant it is in Illinois, and how it's not business friendly in terms of taxation. Um, Otherwise, we like parts of Kansas, we like parts of Missouri. I can even see us. I don't think Arkansas is the Midwest, but I could see us buying in Arkansas if we could find the right thing. I don't see us buying in the deep South. Florida's too expensive, and the Midwest right now. You don't see a lot of deal flow in Minnesota. For some reason, it's just not a lot that comes on the market. And I'd say that's pretty much true of Milwaukee also. I mean, of Wisconsin.
Are there particular asset classes you're buying in certain markets versus other markets? And like,
Yeah.
And what does that look like?
Well, we're buying a lot more core, what I would call core plus these days than value add. Value add has gotten very, very expensive. People will pay dearly. Investors will pay dearly for value add because of the plausible ability to throw in money, increase the value of the real estate, drive the income, and then then realize a solid profit from the sale. But value add right now, you're probably paying a 3 cap. I think a 4 cap is the lowest that you should ever pay. Is the lowest return you should ever pay to buy any real estate. But we hear deals that are going down below 3 cap. Value add deals that are going down below 3 cap. And that's just it's tough. If you're in our business, you also have to be willing to be your own biggest enemy when it comes to underwriting. You have to just be relentless on the underwriting. You have to beat the underwriting to death. So that you can really satisfy yourself without kidding that you're going to make your returns. And so, I just don't think that the yield is right now for value add. When we find value add, we can do it. It's an exception. We will still do it. This bankruptcy portfolio that we bought in Northern California was absolutely value add, a lot of heavy lifting. And so we will still find value add from time to time. But mostly we're doing core plus, right? Core plus is anywhere from new to 20 years old, but the vintage starts with a 2. It's 2000 something, and it might need a little brushing and scrubbing, and maybe you're going to go in and update things and the like. But you're not necessarily expecting value add returns. You're not expecting a 15 IRR. You're content to get something between 10 and 12, and you're buying nice real estate, and you're completing your exchanges, and you should have stable cash flow, and that's probably. If you take the bankruptcy portfolio out of last year, 2020, 2021, 2022, I'd say probably 75 to 80% of what we're doing is core plus.
So A minus, B plus.
Yeah, light. Even A, even A to A minus. It might even be A plus, but it's not going to, if it's A plus, it's not in Miami. It's not in San Diego. It's not in Orange County. It's not in Palo Alto. It's not in, it's not in Bellevue, Washington. It's in Reno, or it's in, it's in Richmond, Virginia, or it's in Nashville. It's in a second city or a tertiary city. But if you're buying something in St. Louis, it might be brand new, and no investor is going to consider that core, because core is not. St. Louis is not a core market.
Yeah. Yeah. I was looking at a deal in St. Louis the other day, just a single family house out there in St. Louis. And I noticed that like, there's this one company that's like buying up like 30, 40, 50 homes like at a time right now, like in those markets. Like, and our thing was like, well, if we could pick this one up, like they got to know something I don't know. well, they're not dumb, right? Like, we'll follow the banks, right? Like,
Sure.
so that St. Louis market, is there something going on there that's really interesting to you?
It's an interesting question. You know, I don't know. I really don't know that much about the single family market. You know, it's just a product type we've never dealt with. The smallest thing we ever bought was a duplex. We did buy
Makes a lot
one
of
of
sense.
those, and then it was a triplex, and then it was a
Yeah.
fourplex, and so far up the curve. But what I'm guessing, and I can only speculate, but what I'm guessing is that this shop, whomever they are, they're seeing, they're probably seeing gentrification. Would be my guess. Wherever they're going, I mean, maybe they're just going in and buying rough stuff, right, and trying to renovate it and then collect rents. Maybe, I don't know. But it's also possible that they're seeing gentrification, in that you know, there's a big push right now for the last 2 years. There's a generational push into home ownership. You know, a lot of people are leaving rentals, they're leaving urban areas, they're leaving one place or another, and they're moving, right? And there's been a big shortage of single family home inventory, which has pushed prices way up. And so, you know, it wouldn't surprise me if this is just, you know, if this operator, you know, sees enough either gentrification or movement of dual income households into certain communities, and, you know, and believes there's going to be appreciation. Um, you know, nobody likes making a bet on something that's just a trend. I'm going to bet on the trend. You like to make your bets property specific. But, you know, upside in the value of a single family home is more than has been more than a trend the last 2 years. It's been a fact. So, I mean, I just guess they're seeing something there that they believe is going to make those executions profitable.
Do you guys follow that's like a similar strategy, going back to kind of like your your partner who's got the institutional kind of mindset, right? Are you guys like plugged into what they're doing, and are you guys following them at all, or
Following institutions?
yeah?
Not so much. We follow the markets much more closely than we follow institutions. You know, we've been at this for a long time. You know, we know what to look for.
You
And
guys
I
are
would
the
say one of the
institution.
other emphases that Tony brought in was just a real kind of macro understanding of supply and demand. You know, for me, I was operating in rent controlled jurisdictions. It was easy to see if the rents were low. You know, if the rents are half a market, it's not an illusion. You know, and you don't need to have a lot of science to know that if that person moves, you're going to be able to double the rent. And so, you know, while I was still practicing in rent controlled markets, and between San Francisco and Oakland, between 1985 and 2001, we probably bought either I myself and the partnerships that I put together, or with the other people that I was working with, we probably bought 40 assets, right? And of those 40 assets, only 4 were not in a rent controlled jurisdiction. So 90% were in a rent controlled jurisdiction. I don't want to say it made it easy. It didn't. Rent control is tough. I mean, it exists for reasons. But it really, you know, it's a master you have to serve if you're a practitioner in that area. But one thing that rent control does is it shows you the upside, right? It's not an illusion if something's renting at half of market. And so I didn't feel like I needed a lot of macroeconomics to understand that. But once we went out and started doing conventional instead of rent controlled markets, you know, I always wondered, you know, is it going to be easier or harder to go into markets that aren't rent controlled? Because you just assume that everybody's indexing their rents all the time, right? And that there may not be that much upside in the rents, but there is. You just have to look for it. And so, you know, we just, you know, Tony brought in an emphasis on macroeconomics, understanding supply and demand and demographics. And we really follow the jobs. What we follow is good paying jobs where jobs are going in. Take Nashville. You know, 10 years ago, you would have said, or even 5 years ago, you would have said Austin, right? Because there's so much job growth in Austin. Well, right now it's Nashville. There are a lot there are a lot of national firms that are moving there. It's happening in Atlanta also. They're leaving higher cost jurisdictions and going places like Nashville and Atlanta. But the jobs growth is not an illusion. You can quantify it. You can see what it's doing in terms of rent growth. And then the other thing we look for is barriers to home ownership, right? If it's difficult to build a home, or it's very expensive to build a home, you might have you might be able to satisfy the housing needs of a dual income couple by leasing them a terrific downtown apartment for $2,500 a month, right? But if they want to get the house that they want to buy, they may have to pay $500,000 to $750,000 for a house that they want. So we look at that. We don't ever want anyone to be a prisoner, but we look at places where we can provide a really good value alternative for people and a lifestyle that they want until they're ready to do something else. So, but if once upon a time in the early years when we were looking at Boise, we've been in Boise for the last 10 years, but we were looking at it before. You could rent an apartment for $600, and you could go buy a new subdivision home out on the prairie for $120,000. We didn't think that was a recipe for success, because if you have clean credit and you can get a down payment, you're going to buy a house. You're not necessarily going to rent an apartment. That's changed, right? But we like it where people with good incomes, good jobs, dual incomes, where it's appropriate, are going to look for a really great multifamily housing experience, and we know how to provide that, and we also know how to be a value alternative on that. We're not the A++ operator. We're A+ sometimes, but more typically A to A-. But we know how to present a property so that even if it's an A- property, we'll have plenty of people who want to live with us, because we can provide the same experience that they would get at a double A+ property and pay $1,000 more for.
Right. So you guys have really hammered down the markets that are basically super high housing but manageable rents, so that you can provide them just a real good experience, and you guys know how to do it probably relatively inexpensively compared to some of the other operators, just because of the experience.
I think we provide a really good value proposition, really good housing experience at a number that seems to be attractive to people. We run 95, 96, 97% full. We don't jackknife rents on continuing tenants. If there's upside, there'll be some kind of an increase, but we're not gonna try to move them to market just because the rent's gone up by 20%. If the rent's gone up by 20%, they want to stay. We might be happy with a 5 to 8% increase. We're going to expect something, but we don't want to chase people off, right? We don't want to run people off. And we learned in the Great Recession, 2008, 9, 10, and we learned during the early months of COVID that what people wanted, they don't want to move, right? They don't want to move. And unless you give somebody a reason to move, they're going to be happy to stay where they are, right? Yeah. And we even walked back. We do rental increases every year, right? And we give a good long notice for when they're coming. And we had given increases for we had given the increases or the notices for rental increases, and for January, February, March of 2020. And then when the shit hit the fan, we walked them all back. Right? Because we didn't want anybody to feel like they were being pushed. We didn't want anybody to feel like they needed to move. We wanted to help them stay. And we know that by being careful with turnover, right? Being mindful about your turnover and meeting the market, it's going to give you the best chance to stay full. And your best results are going to come the more fully occupied you are.
Yeah, absolutely. And so we're gearing up on time here, so I gotta get you off of this.
I'm fine. You can kick me off anytime you want. I'm having fun.
But so are you guys finding that there are certain amenities or certain I don't know, lifestyle options or whatever that's like super attractive? And are you guys basically like taking this like templated model and just cookie cuttering it on every property, or how does that
work? Pretty much. I mean, we like doing things where we could do them more than just once. We wouldn't just like we wouldn't want to buy one property in Omaha, Nebraska. If we had an opportunity at 6 to 10 properties in Omaha, Nebraska, and we thought we could understand them, we'd be happy to do it. But we don't, there's no real efficiency in doing something just once. So yeah, we have tricks of the trade. We have things that we look at. I will tell you that they're all pretty basic. The garden variety stuff is quite frankly, nice landscaping, a nice clubhouse, a fitness center, a pool, a nice pool area, a spa. These days, more and more, what you're doing is you're making sure that those outdoor areas are also outfitted with grills and one thing or another, and what we call an outdoor living room. It may be, it may really feel like an outdoor kitchen, right? Like a full-on outdoor kitchen with nice seating areas and the like. That's popular. We like doing that. You're going to do some stuff that's purely about design value, right? You're going to make your outdoor areas and your amenities pop, right? So that people really, get turned on when they see it. And then otherwise, you've got things like, dog parks, pet parks. We do that. We like that. Believe it or not, pet washing stations. Yeah, we have those. That's a big thing. Sometimes, if we have the room for it, we'll put in something like an outdoor car washing station. It's all pretty basic stuff. Of course, you're going to have outdoor Wi-Fi and all the rest of it. You're going to have in some of our properties we have bike lockers in the clubhouses. Sometimes we'll have a kind of a shop space that people can go in with their bikes and tune up their own bikes with, in the shop, or maybe it's tuning up their skis, right? If it's Colorado, it's that kind of stuff. But it's really mostly bits and pieces of little things that give somebody a perk, right? That are useful or fun, or pleasant to have, and that are easy to weave into the residents' living experience. But it's been a full-on arms race for amenities for probably, the last 6 or 8 years, and everybody's coming up with new things to put in.
Yeah, interesting. Okay.
Package lockers, package lockers. We like those. People like those. It's a good thing. It's just little elements.
Yeah. So just going those little extra things that people might not do, and you guys do it, and it provides a better experience. And
we have to remember, people vote with their feet, right? And if a couple of folks, have a household together, and they're going to go out and rent an apartment, they're not just going to come to your place, right? They're not going to see your place and, okay, I'm done, and can I sign a lease now, right? We love to look, right? People love to look. They like to see, well, let's go see this other one because that looked pretty good too, right? And so, whether it's because you have something that you haven't taken care of, or you have a conspicuous deficit of amenities, you don't want to give people an incentive to go somewhere else. You want to give them an incentive to do business with you. And by keeping things in good order and having good staff and having attractive amenities and being, and great landscaping and being easy to look at and pleasant to look at, you're giving yourself the best chance to have someone decide to, when they finally get ready to sign a lease, that they want to sign the lease with you.
Yeah, I think that's super great advice. So, all right, well, Mark, I've kept you for an hour.
No, it's fine. It's been great.
And I really appreciate your time. Where can people connect with you?
So I always just give people my my email address. It's Mark, M-A-R-K, at Hamilton, Hamilton, Zanz, Z as in zebra, A, N as in Nancy, Z as in zebra, E, HamiltonZanz.com. We do have a company LinkedIn page. And we also, we have a great website. I mean, I'll tell you frankly, I do not hesitate to give our website a plug. It tells the story well. It's easy to look at. It's easy to navigate. It really gives a good overview of what we're doing and why and where. But if anybody wants to connect with me directly, just send me an email.
Awesome. Yeah, I was looking at your website earlier. Millennial definitely did that one.
Yeah. Oh yeah.
I couldn't do it, and I had the Gen Z chick or whatever with all the, fancy Canva and the Wix thing. I was like, all right, you design it. Like, I'm moving on.
Yeah. No, I did not design the website.
But interesting. Cool. Awesome. And if you guys are interested in learning more about the Deferred Sales Trust, we have a mastermind every Friday at 10 a.m. Pacific, 1 p.m. Eastern. You can go to capitalgainstaxsolutions.com to learn more about that. That's capitalgainstaxsolutions.com. And Mark, I'll definitely send you an invite so you can come on.
I enjoyed myself. I enjoyed meeting you.
Yeah, absolutely. It's been an awesome interview. I got a ton of just phenomenal value out of this. So thank you so much.
Invite me back.
Oh, absolutely. We have another one too that we'll definitely invite you on. So
I look forward to it.
Yeah, absolutely. So, and thank you again, everybody, for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy, such as the Deferred Sales Trust, an accurate 1031 exchange, a Delaware statutory trust, a charitable remainder trust, is the best way to create, preserve, and grow your wealth. Please rate, review, and subscribe. Share, like, thumbs up, notification bell, all that stuff. And we'll see you guys on the next one. Mark, thanks again.
Thanks a lot, Pierce. I'll look for you.
Yep. See you guys.